Welcome to Cryptonomics, your premier destination where future meets finance. I am Delta, a seasoned investor and economist, and today I will be sharing with you my top 3 picks for a short squeeze when interest rates actually go down. You might have heard about a short squeeze following the saga of GameStop and AMC. You might have seen the movie Dumb Money, recently released on Netflix. If you haven't seen it, highly recommend you check it out. In today's video, I will be sharing with you my top 3 picks for when Fed actually lowers their interest rates. I will teach you about what a short squeeze is and how to spot these companies. This is not always a given that you should buy a company that's heavily shorted. Usually it means the opposite. If a company is heavily shorted, investors shorting it may know something that we don't know, that the company is likely to fail in a big way, and then their price will go down, which will benefit them. Sometimes these investment firms that short companies make a mistake, as they did with 2 very prominent examples historically I will share with you today. And then I will show you my top 3 picks that are interest rate dependent. Doesn't mean you should go and buy these companies now just because they're heavily shorted. It means that you should pay attention, and if and when interest rates start going down, this may be a good opportunity to start adding to a position, a long position, where shorts may be forced to buy back from you at a higher price. If you already know what a short squeeze is, feel free to skip ahead using the timestamps to either my top 3 picks or historical examples of massive short squeezes if you would like to learn a fun investment historic lesson of how shorting companies can go terribly wrong. And if you can spot these terribly wrong shorts, you can make a lot of money. What is a short squeeze? A short squeeze occurs when a stock market, when an investor who has taken a short position in the stock, which is betting the price will fall, are forced to buy the shares to cover their position while it's unexpectedly rising. This upward price momentum can be triggered by positive news, robust earnings report, or other factors that drive demand of the stock. One example is people just notice that it's heavily shorted and say, no, you don't, and they create the squeeze. A short seller then is forced to rush and buy these shares to limit their losses. An increase in buying activity further drives the stock price up. This is a positive feedback loop where if I was a short seller, now I'm forced to buy shares at a higher price, further driving the price higher. Now I'm forcing other short sellers to also buy because they have to limit their losses. And this is a positive feedback loop where the price just keeps rising and rising, further adding to the losses of the short sellers who have to buy back. The term squeeze arises from the pressure on the short sellers to quickly exit the position, contributing to the rapid, sometimes dramatic increase to stock price value. Because this is not a fundamental reason necessarily why the stock is going up. It's going up because they're forced to buy it. The short squeeze can lead to significant market volatility and create challenges for investors on both sides of the trade. Longs versus shorts, how it works and what fuels a short squeeze. When an investor takes a long position or buys a stock, the maximum possible loss is limited to 100% of the capital invested. Think about if you bought Facebook or Meta shares today at $480. Most you can lose is $480. Absolutely, the price can only go to 0, company goes bankrupt, and you lose 100% of your money. Conversely, because short sellers borrow shares and then sell them, there is theoretically no upper limit to how much money they can lose because the price can go up infinitely. If a stock rises significantly, there is no ceiling on how high it can go because the short side is much riskier when trade goes in the wrong direction, up. For shorts, they are forced to rush and buy to cover their position. Cover means limit their losses or close out their position, which is to repay the borrowed shares they sold. Adding further upside fuel to the stock. It's pouring fuel on an existing fire. The higher the stock goes, the more this phenomena snowballs and bigger the flames get. This is a famous example of Volkswagen that had a short squeeze. When GameStop was first happening, and we will cover that next, first thing I thought of was this will be like Volkswagen short squeeze. And this was my rubric to copying what to expect will happen. This is a 5x in price at least of the short squeeze. This is the history of Volkswagen short squeeze and can be traced back to 2006 when Porsche decided to start acquiring sizable shares in the German automaker. The result in the price progressively climbing higher levels for months. In 2008, the short sellers started to bet against the stock as they realized that Porsche would start limiting their purchases after they amassed about 30%. Them buying right here made the stock go up from whatever it was to about 400, basically doubled. And the short sellers, they shorted here thinking like, oh, well, they can't buy anymore. This is where they made a mistake. This is where they realized they effed up. However, Porsche did not stop buying shares of VW as the market participants expected. In March of that year, the company revealed that it had actually upped its stake to over 40%, but it also held around 31% of company shares in options. So it had 40 already and the right to purchase another 30 in options, giving it a total of 70%. Combined with a 20% back then, the German government also owned a 20% stake, which means that less than 10% of the company's float was actually available and accessible to traders in the open market. This is similar to what happened with GameStop, and we will cover that next. So basically, Porsche owned 70%, the German government owned 20%, which means there was only 10% of the shares left to be purchased. So, investment fund had reportedly borrowed around 12 to 13% of the company's shares. Once they realized the positions they were in, they started to buy the stock to cover the open short position as it became clear that they were victims of a short squeeze. According to international banker, ultimately those hedge funds who had shorted VW's stock ended up losing an estimated $30 billion of their trade. Because these short sellers sold more than 10% of the company's shares short, 12 of 13, but there was only 10 available to buy, that means it was impossible for them to cover. They got squoze hard. When you squeeze something, it stays squoze. In this scenario, the hedge funds that shorted VW borrowed 13% of the shares, sold them, hoping to repurchase them later at a lower price, and then returned the borrowed shares. Unlucky for them, Porsche, together with the German government, owned 90% of the shares, which means it was impossible for them to cover their short position. So they started to get squeezed, and once something gets squeezed that's hard, it stays squoze. The movie Dumb Money on Netflix. It's, I think, hour and a half, 2 hour long movie, hilarious, worth a watch. Maybe not hilarious if you're not a fan of investing, but if you now understand what short squeeze is and what shorting is, you will really appreciate this movie. Stellar cast, really well done. I am a hard critic when it comes to investment and finance movies, and this one was done well. I just wish they explained the percentage of the short better in that movie, which I will do now. At the beginning of COVID-19 pandemic, no serious investor predicted that the struggling chain brick and mortar company would become most talked about stock in 2021. Certainly not managers of Malvern Capital, a hedge fund that began placing multi-billion-dollar short trades on GameStop leading up to the 2020 holiday season. In 2020, I noticed that Michael Burry, also from a famous movie, The Big Short, had acquired a stake in GameStop. I thought it was a silly decision, so I just went and I researched GameStop, And when I looked at their financials, I saw this. I saw shares short and how many shares were outstanding, and more shares were short than existed, which reminded me of VW Porsche story. There was more shares shorted than existed. It was short, I think, 120 or 150% of the shares, which means it was impossible for them to actually cover should they be squoze. So GameStop was trading around $2 to $3 here. When it hit my radar, it was about $4. And then the short squeeze happened. Retail investors on Reddit and other online communities noticed what I noticed, probably following Michael Burry's call to purchase it, that the short interest against GameStop was very large. And this was called what's called a naked short, which means they had no ability to cover this. This is a predatory practice of selling non-existent shares in order to bet against the company. So they sold shares that didn't even exist. You can't sell more of 100% of something. If I had 100 apples, but I sell you 120 apples, that means there's 20 apples you didn't get that I manifested out of thin air. Knowing that the hedge funds would soon have to cover their shorts, online traders began heavily investing in GameStop and making the price go up. This crash right here, this is when Robinhood did a naughty thing. As a result, the short squeeze reverberated through the markets. In January 2021, GameStop shares soared to $17, from $17 to $500. Before several brokerages limited buys of GameStop and other meme stocks. The hedge funds were forced to close their short position with billions in losses. A few months later, the hedge fund that had the biggest short position, Melvin Capital, went bankrupt. This was the end of the GameStop saga, as brokerage firms were accused of manipulating the market in favor of their institutional clients. Several federal state regulatory investigations of short sellers and multiple class action lawsuits were filed against brokerages that halted trading. What Robinhood did here was they allowed people only the sell button. They could not buy anymore and drive the price further squeezing the shorts. They only allowed selling. So there was only a sell button available. This was profoundly effed up of Robinhood and the reason I don't trust that exchange. Now, GameStop is still 22% short. Now, this isn't a candidate for a massive short squeeze because, or it still could be, but because 22% is very different from 122% that makes that colossal short squeeze possible. What do you need to know when it comes to short squeezes? Trading heavily shorted stocks has its pros and cons. The primary benefit is there is more upside potential than usually given that stock's fundamentals. Conversely, the main negative of trading short squeezes is that the stocks tend to be more volatile and carry more risk. To combat that risk, investors can do a few things. One, you can choose not to trade or invest in these companies if it's too volatile and risky for you. You can trade them with a small amount or have a stop loss in place. In the example of GameStop, at $4 a share, you could have spent $400 and had 100 shares, which at $500 a share would be about $50,000. So starting with $400, you could have ridden up GameStop to $50,000. Now this isn't always the case because this was a massive short squeeze. There's also something called options. You can buy a call option that there is a limited risk. It can go down to zero and that's it. But this is only recommended for experienced investors who understand derivatives. Unlike Robinhood, that doesn't even have numbers on their y-axis of their charts, I don't recommend people buy call options unless they really know what they're doing and they have a huge advantage over the market. Derivatives are most complicated or some of the most complicated financial instruments, and most of them, vast majority of options expire worthless, which means they go to zero. If you think yours won't, you'll be joining the vast majority who also thought that. Personally, when I buy options, they are far into the future, either a year or longer, sometimes several years. Currently, I do have call options on my biggest stock position, which is Coinbase. But those call options that I purchased had about 2 years of time premium on them until expiration. Even if that goes to zero, it was such a small investment relative to my portfolio. One of the best ways to use call options and options in general is to hedge your risk or to make income on long-term holdings you plan to hold anyways. Federal funds rate that is set by the FOMC, Federal Open Market Committee, permeates through the economy and it affects everything. It affects how much you can get your mortgage for, your car payment, how much banks will charge to lend money to businesses and individuals. All three of these interest-sensitive companies go down when interest rates go up, and when interest rates go down, these companies tend to make more money because they are very dependent on interest rates. More cars get bought when interest rates are lower. Your monthly car payment is lower if interest rates are lower, because a big part of the payment is interest. If the interest on your car loan is lower, that means you can buy more cars. If right now you can't afford a car because your interest payment is several $100s more than you could afford monthly, once that is lower, it may incentivize you to purchase a vehicle. This same goes for house. Real estate market is in a rut right now because the rates are very high compared to what they were a couple of years ago. People buying the same house now are paying almost double their monthly payments for the same amount of house. If you purchased a house a few years ago, you benefited from low interest rates, and maybe that's why you bought it. When interest rates go down, there is a lot of pent-up demand. There's a lot of people on the sidelines that are waiting to buy a house. They just need the interest rates to come down slightly so they can afford their monthly mortgage payment. Lastly, more loans are given out for cars, houses when rates are lower, and more people qualify when economy isn't in a dumpster fire. Generally, companies that do lending lend out more money and have more customers and earn more money on interest, and companies that provide software and services to lending companies also do better as their services are needed more. Which brings us to our 3 picks of heavily shorted companies that are interest rate sensitive, that should do really well when interest rates go down, which will create a short squeeze on these short sellers. First one is Upstart. Upstart operates cloud-based artificial intelligence lending platform. Its platform aggregates consumer demand for loans and connects it to a network of companies' AI-enabled banks and credit union partners, and is able to predict risk of a customer better than their credit score. Right now, Upstart has 41% shorts of their float. This is pretty big. Now, they have a lot of customers, and this is generally thought of as a decent company. Upstart is currently trading at about $32, $33. Its high was about $400 back in October of 2021 at the peak of the bull market. Since then, it's corrected heavily, as low as $15 and recently as high as about $70. Right now, it's trading about $33. Looking at their stats, and this is something you can also do, is just go to Yahoo Finance, type in the ticker symbol, and look around, look at the numbers. This is how you can easily do analysis. This is free, publicly available data. They were worth $1 billion in 22, and they've gone up to about 3. So they have 3x from their bottom already. Right now, their profit margin is negative. Their operating margin is negative, return on assets is negative, return on equity obviously negative because the equity went down. Their revenue is $500 million. Their quarterly revenue growth is down 10%, which is not good. And their net income was a loss of $253 million. They have $500 million in cash. They have $1.25 billion of debt, which is pretty high. We're not happy about that. And let's take a look. Their short float is 40%. This company is not doing well financially, as you can tell. As you can see right here by all the negative numbers. You literally don't need to actually know if 500 is good or 200 is good. If you see all these negative numbers in their financial highlights, that's usually a bad news bears for this company. Also, if they have a lot of debt, that's not good. As we discussed right now, this is interest rate sensitive. So if they have to refinance their debt, they will be doing it at higher interest rates. Also really bad for them. But should interest rates come down, their profit margin and their revenue should go up as lenders find more uses for their product, which is AI, that is better at understanding risk, originating a loan. One positive thing to look out for is what percentage of the shares are held by insiders. And 15.5% is pretty high, which means people that have the most intimate knowledge of the company are holding on to these shares because they believe they'll be worth more in the future. These people have a direct impact whether this company succeeds or not. They're capable of selling and making rational decisions. So 15% is really, really high. Looking at their analysis of their financials, looks like the estimates have been trending in a positive direction and are expected to be positive in 2024. Looks like revenue estimates are trending upwards for 2024. And generally, analysts recommend it as a buy or a hold compared to underperform or sell. Now, don't put a lot of stock in this, just a general pulse of what the analyst thinks. All right, so Upstart at 40% plus short is our, in no particular order, number one short squeeze candidate when interest rates go up. Next one is, drumroll, Carvana. Are you familiar with Carvana? It is a vending machine for cars. Where I live, they are next to the highway, freeway, whatever you call it in your neck of the woods. And it's these long buildings that look like a vending machine for cars. And this is their website. You can just go look for a car. And if you like it, you press buy and they ship it to you for either a fee or free. You can look for whatever car you want. You can check the mileage. It is certified and clean and has a Carfax report, I think, right there. No accidents. You click buy and it gets delivered. I really like this company. Their financials could be better. Seems like they're making a turnaround. But I tried purchasing a car not too long ago. I went and I made my Lexus on the Toyota website and I thought I could just click buy and deliver it to my house. No, it wanted to send me to a dealer where I go and I talk to them. I don't know why this middleman people are in the middle. There's no way I'm going to go talk to a dealer and negotiate some stuff. I already picked a car. I just want to click buy and have it delivered to my house, just like Tesla does it. Carvana does this for used cars. And I think it's a great innovation for people like myself who will rather die than go talk to a dealer. So, Stock Carvana is an online auto retail platform where customers can go buy and sell used cars entirely online. The company offers a wide selection of pre-owned vehicles. Entire car buying process, including financing, delivery, can be completed through their website. Carvana aims to simplify and modernize the car buying experience. Thank you, Carvana. I wish everybody did this. Last year, Carvana was on the brink of bankruptcy where its stock went down to almost $3. However, the company secured funding during the 2022 bear market and turned around their business and never looked back. Now, as things are looking up for this leader in online auto sales, to say the least, the stock is up more than 500% over the past year. And their next competitor is Vroom, announced it's shutting down. So it was a difficult business. Car prices were really high during the pandemic because there was a chip shortage, and used car prices sometimes were higher than new cars. I remember this. I was looking. So now with less competition, Carvana can grab a larger market share of being a totally online auto retail platform. The shares are breaking out, and there's an eye-popping interest of 44% short of float. This should boost the stock even further should the prices keep going up. All right. Quick commercial for Carvana. Not paid. I just think it's cool. Look, you can buy a Tesla for 28 grand that has 31,000 miles on it. I think this Tesla, 2015, has free lifetime supercharging. So you never ever have to pay for gas or electricity even if you just use the superchargers. This car is faster than a Ferrari or a Porsche. Why would you not buy a car for 28 grand and the math of how much you pay for gas? This is a free car. Okay, public announcement done. Let's take a gander at Carvana's financials and their chart. Recently, it's seen a little bumpy bump. Today, let's look at a longer time frame. What did Carvana do this week? Little chop. What did it do this month? It went down from 50 to 43, perhaps an opportunity. In the last 3 months, it's gone up from 30 to 50 to 43. Reversion to mean, perhaps. In the last 6 months, it's been dancing all over the place. It's been as low as 27. In the last year, it's been as low as 7. What's the low here? 6? Wow. Wow, look at this. Look at this. This chart just blows my mind. This is the pandemic, and it's going up. And it hit the peak of close to 350, 360, and then it started coming down. Now, where did the shorts initiate the position? Possibly up higher somewhere. Why they haven't closed yet is anybody's opinion. At 40% and the current trend looking like it's headed up, perhaps there will be a short squeeze. I would think that the squeeze would materialize if more people start using Carvana, and millennials like myself will probably opt into using an online retailer to purchase their vehicle rather than going to a dealer and haggling. I just want to know how much. I'm going to put in my credit card or whatever, click buy, deliver to my house. I've driven a Tesla. I don't need to test drive it. They're all the same. I call this a continuity error. A continuity error. Or deja vu. Did you see a cat? I didn't see a cat. Okay. Chill. All right. Now that the kitty is in on the video, smash that like button if you like kitties. Let's look at the stats of Carvana. Stat. This is at the lowest point of 22. Was worth $500 million, 500 million. Now it's pretty much 10x that already. Does it have room to go up more? Well, it was 10x higher than it is now before, possibly. Its financials actually look way better than Upstart. Return on equity is terrible because it crashed. But if you look at the profit margin, operating margin, revenue per share, EBITDA, net income, all pretty good. We don't like the loss. but perhaps this is a strategy to acquire more market share. They have a lot of debt. That's because they purchase the cars and then they resell them. And here is the short. There are 34 million shares short out of 84. So here it is. How is it that 100 and plus percent is owned by institutions when there can only be 100 shares? Think about it. Think about it. Financials. Let's take a look at these financials. Revenue, steady going up. Net income, huge loss here. Back to under control. We'll love to see that flip positive, and it possibly can if interest rates go down. There were 3 beats in the last 3 earnings. Anyways, I like the stock, especially if interest rates go down. We buy more cars. And our number 3 stock that's heavily shorted that should do well if interest rates go down is, drumroll, it's Redfin. It's Redfin. Are you familiar with Zillow for your home shopping needs? Well, meet Redfin. Its younger, smaller brother. Redfin operates a residential real estate brokerage company. The company operates online retail estate marketplace and provides real estate services, including assisting individuals in purchasing and selling homes. It also provides title and settlement services. It originates and sells mortgages. The company was formerly known as Appliance Computing, and it changed its name to Redfin in 2006. Now, Redfin is at 28.26 as of January 12th. Let's take a look at more recent numbers. So the market cap of Redfin is about $1 billion, little shy, 974 million. It's been as low as $4 in the last 52 weeks and as high as 17. So there was a bump right here to 17 and it went back down. It was as high as 100, almost 100 in February of 2021. And since then, as interest rates went up at an unprecedented pace, Redfin's business, which is real estate, got crushed. So let's take a look at the stats. Take a look at the stats. Redfin, as low as 400 million in December 2022. It's been fluctuating between 1.5 billion and 1. Its profit margins, loss, almost 8%. Operating margin, almost negative 10%. Return on assets, negative. Return on equity, obviously negative. Equity is crashing. Revenue, 2 billion. Gross profit, EBITDA, and net income, negative 202 million. Negative 1.8 earnings per share. That means they're losing money. They have almost $1 billion of debt. That's not good. It is currently shorted at 28% as of the 12th. So this hasn't been updated since I looked last. Again, this is another company that can do really well if interest rates go down. What we can do is add the fuel to the fire, 28%. Not your 100% of VW or GameStop. So this is slightly different, but this is fuel for the fire. Okay, so the FOMC meetings, we just had one, January 30th. Next one is March 1920. This is the one to look out for, or April-May one. During one of these, they may signal that they will lower interest rates soon. They likely will say at the next meeting, kind of guide expectations that they will lower interest rates. Yesterday or the day before, they guided that they will keep interest rates as they are for longer. So they will first communicate that they will lower interest rates, then actually do it. Interesting thing about monetary policy is communication is more impactful than their actual decision. When they say they will lower interest rates in the future, that moves the market more than when they actually do the lowering. So when they say they will lower interest rates in the future, or at the next meeting perhaps, that will be the time to start a long position on the heavily shorted stocks that are interest rate sensitive. When the FOMC next communicates that they will start lowering interest rates in the following meetings, that will be the time to start positioning to take advantage of the possible short squeeze on these three heavily shorted interest rate sensitive companies: Carvana, Redfin, and Upstart. There may be others, but these are the three that I noticed had a really high short interest and that should do better when interest rates are lower, regardless if their financials immediately improve or not. The market will front run their business model getting better thanks to lower interest rates. So just the act of market believing these companies will do better and bidding up the share price will squeeze the shorts and force them to purchase shares at a higher price, further driving the cycle up in a positive feedback loop, similar to what we saw for VW and GameStop, but not of that order of magnitude. Those companies, those hedge funds that shorted those companies, shorted past the percentages or limit of available shares for them to cover. 20 to 40% what these companies are can be covered and can drive price up, but we don't know when they exactly started their short position. If they did it at a much higher price, they may be happy to cover all the way to the price even doubling from here or tripling and still be in profit. GameStop and VW were exceptions where the short sellers sold more than the available shares they could buy back to cover. Short squeezes are a fascinating aspect of investing in the stock market. When there is a short squeeze, longs, people that just purchase and hold shares, can do really well if there is a short squeeze. In today's video, we discussed a fundamental catalyst for these three companies, which is interest rates. These three companies are dependent on interest rates. Their business does much better in a lower interest rate environment. The short sellers are betting that these companies will continue to deteriorate in their financials and possibly go bankrupt. If interest rates are lowered, that could signal a turnaround for these companies. As we can see, Carvana is already in the process of a turnaround because there was a shortage of cars during the pandemic. Used cars in particular were very expensive, and that's possibly why their stock tanked so hard, because they probably overpaid for their inventory and they could not sell it at those prices with a markup. So there you have it. Those are my top 3 picks of heavily shorted companies that should benefit from lowered interest rate environment. Upstart at 41% short of float, Carvana at 43% of short, and Redfin 28% of short. Now, this is not foolproof. This is not without risk. These companies can continue to hemorrhage money and still fail due to bad management decisions. Like Carvana could purchase a lot of cars at expensive prices and fail to resell them and have to sell them at a loss. Redfin can engage in giving out loans that people default on because the economy takes a turn for the worse, and then they're stuck holding the bags. Upstart could fail to get more customers to pay for their software, or a competitor could come in and provide better service at a cheaper price and take market share from them. So all of these have risks, but all of these also offer a lot of reward should their businesses turn around with the interest rate pivot from the Fed, as well as company share prices going up will create a squeeze for the short sellers. Currently, I only have shares of Redfin and Upstart. I do not have any Carvana shares. My Redfin and Upstart are very, very small positions, mostly because they're currently at a loss. I bought them on much higher prices. And I will consider adding to these positions and adding Carvana once I feel confident that the Fed will start lowering interest rates, or if I see a material change in the financials of these companies for the better. Upstart sells software, and that is usually a high margin business. Carvana is, in my opinion, one of the best ways to purchase a car, and Redfin is a duopoly along with Zillow. They're the two online marketplaces for purchasing homes that should do well once real estate market rebounds. So, if you are looking to stay ahead in the world of finance, learn about strategies like short squeeze, arbitrage, derivatives, fundamental analysis, make sure to hit that bell icon and subscribe, and together we can conquer the world of finance. As always, may the force of compound interest be with you. Peace.
Peace.